So everyone, we'll get started now. Thanks for coming on. As I mentioned just a little bit earlier, it's a small, intimate group today. So you have our full attention wise. Next week, we're going to have a much larger group wise. So you guys are the lucky ones that got us today. So just to introduce yourself to everyone, I'm Alex Wilson, broker owner, Remax Wealth Builders Real Estate and team lead, alexshaywilson.com. Co-founder of Remax Wealth. I don't know how it shows up anyone else's screen, but is beside me Kyle DeVici, also an investor. And below me on the screen is Amit Puri, our trusted mortgage broker, specializes in refinances of condos wise, but other products as well. But his background is in accounting and in mortgages, so he can really provide a great in-depth analysis for you. And I know in our mail, our blast that we send out to Amit, so by volume wise in 2018, 2019, you were number one in Ontario. Would that be for the brokerage?
That was actually Ontario-wide for all mortgage brokers. So it was number 3 in 17 and number 1 for 18 and 19.
So there you go, guys. We only to speak with you. So the focus of our webinars this month has showing people how to use equity to really leverage themselves and grow their portfolio and build wealth-wise. Many times we come across people that have these properties they've owned for a number of years and have small mortgages on them, and there's the mindset that mortgages are bad and you need to pay them off. And that is true with your principal residence. When you have a mortgage on your principal residence, that's debt. You cannot write that interest off. It's not making you money. You want to pay that down. But when it comes to your investment properties, it's a much different conversation. And I liken it to a game of Monopoly wise. You start off with one property, Baltic Avenue, you start that on the game, and then you start moving your way around the board. You start charging rent on Baltic Avenue. You're able to start getting that rent coming in. You leverage that property, and then you start moving around the board, buying more properties until you get all the way to Park Place, and you own a number of properties. That's the same in real estate wise. So when you put a mortgage on your investment property or use a home equity line of credit on your investment property, you're leveraging the property. And as long as you're putting in another investment asset, and we recommend real estate wise, you're running a more efficient portfolio and helping to grow and leverage your portfolio wise. And the idea is, instead of having one property, you're going to have one property going up in value. You're going to have three properties going up in value wise, which is much more profitable for you over the long term wise. And the key thing is if you're earning excess cash flow, that money is just getting taxed away. Depending on what tax bracket you at, the higher you are at, the higher you are, the more it's going to get taxed away. By reducing that amount, by increasing the leverage on the property and buying more properties, the appreciation of a property is not taxed until you sell that property wise. So you're in a much better tax situation by decreasing your cash flow, by increasing the leverage, the mortgage, or the home equity credit line of credit on the property, and then buying more property. So over time, those are all going up in value wise. So that's really what we're going to talk about today, and then answer any mortgage questions you may have. Now, Kyle, what's the best way to ask us a question?
Definitely by entering into the Q&A panel at the bottom. We'll answer every question that we receive through there and make sure that we don't miss any.
Yeah, and because it's a smaller group today, we will be able to get to all your questions. And we're looking to have this done by noon today. So what I'm going to start off with is I just put a quick little presentation together. We'll go over that, and then we'll go into the Q&A portion wise. And Emmett always does a great job correcting anything that I say that I'm wrong. And he'll interact with us, and he'll help answer our questions wise to give you that expert opinion. But why I put this presentation together, everything I do is I show people how I've done it. These are all real life examples. This is what I've done. This is my real estate portfolio wise. And everyone on here can do the same thing. I'm from a small town in Northern Ontario. Kyle's from a small town in Northern Ontario. Amit, I don't even know what your background is.
But actually, I'm
I don't think you're from a small
born and
town.
raised in London, Ontario. So
Okay.
technically,
Yeah. So he came from a smaller community outside of the GTA, and we've all built ourselves up on our own. And anything we can do, you guys can all do on here, and that's why we show you this this presentation. So I'm just going to share my screen for everyone now. Why maximize your portfolio? Gave you a quick introduction of it already. If your property is increased in value, it's just dead money in the property wise. You're not making a return on that money. The only return you're making is the rent that you're getting on the property. So as your property goes up in value and as equity is paid down and your rent is relatively fixed, your return on investment on a rent basis, it becomes worse every year because property values go up and equity pay down pays down the debt on the property wise, the leverage on the property. So you always want to be looking at how can I leverage property to get a better return on my property. That's where you use equity, other people's money to expand your portfolio. And what I mean by other people's money, it's the bank's money. The bank is going to give you money at a certain rate. And as long as you invest it at a higher rate of return, you're going to make money. That's exactly what investment bankers do all day long. So what we're creating is an investment banker style of investing for you, but in the simplest of terms wise, just buying a roof over someone's head and someone giving you money in exchange for that roof over their head. Very, very simple transaction. And you always want to make sure you're paying the right and lowest interest rate. And that's where Amit comes into play, and we'll probably cover that more in the Q&A period was. So I talked about cash flow. So if you get too much positive cash flow, that money just gets taxed away. You couldn't increase the equity in a property to purchase more investment units. I'd rather multiple properties going up in value than having too much cash flow that is really not going to make a difference in my life, is not going to make a difference in my retirement planning. But if I have multiple properties going up in value, it's definitely going to make a difference in my retirement planning and lifestyle. Too much negative cash flow, that puts you in risk. So we don't want to create a negative cash flow portfolio wise, because if there's something that happens to you and you can't maintain the payback on that negative cash flow, then it could put you in a situation where you have to sell. Now, the key thing in real estate is you only lose money when you sell. So never sell. And that doesn't mean you don't sell or readjust your portfolio. But what I mean is you never want to put yourself in a situation where you have to sell. When you put yourself in the situation where you have to sell, you put yourself in a situation where you have the potential to lose money, because it's not the ideal time to sell, then you can lose money. So we focus on the neutral cash flow. You minimize your taxable income, and it efficiently uses the equity in the property by maximizing the number of investment properties you own that are appreciating in value and having your equity paid down. Now, what I did is I created a case study to show everyone how this works. This is what I did. This is how I've grown my portfolio. So I bought a condo in 2012 at the Carnaby. Kyle owns in the same building as well. I bought that condo for $262,400. The current market value, now this was in 2018. My current market value on this condo is actually $600 now. So we just even showed you how it's gone up from 2018 to now. But we have the current market value on $500 when I did these calculations. The current mortgage on the property was $202,841. The rental market rental rate was $2,100 per month. So what I did is I went to someone like Amit. I'm like, Amit, I want to refinance my property. He's like, how much it's worth? I'm like, $500,000. He submits the application. Bank goes, checks it out. Yep, it's $500,000. We're willing to give you a new mortgage for $400,000. 80% loan to value of $500,000. So you just take 80% by 500. That's how you get the $400,000. And that $2,100 a month services that additional leverage that we're putting on the property. So we have $400,000. We pay off the current mortgage of $202,000. That means I have $197,159 to invest. Now, Amit, what's beautiful about that refinance money? Do I pay any tax on it?
Tax free, baby.
That I pay no tax on that. Tax
Every dime taken out on any real estate is tax free until you sell it.
until you sell. Until you have a selling transaction wise, we can now invest without incurring a taxes payable. So what did I do with that $197,000? No, I didn't go buy a new car or go on vacation or anything like that. I put that back in the market wise. I bought more real estate. So I used that money, bought 2 more pre-construction condos, one at 75 the Esplanade, one at Canary Block. Bought one for $380,900, another one for $578,900. The current market value on those when I did this was $483,000 and $750,000. So just by refinancing, I made another $320,000 by investing that money back into the pre-construction market. Now, what happens over 5 years? Well, the great thing is things will continue to go up in value. This is where the appreciation play comes in. Because a lot of you be like, well, let's take my money off the table now. But this is such a long game. It's long, it's boring, and I'm going to show you how long and boring but exciting it can be at the end of all of this. So if I assume a conservative 5% compounded annual growth wise on the 3 properties. Now the average rate of appreciation for downtown Toronto condos has been 9.4% over the last 5 years. So we're very conservative with 5%. My Carnaby condo over the next 5 years goes up in value. And we've seen that. It's today. I did this in 2018, where I said it was worth 500. Today, it's worth 600. So I'm anticipating when I did this presentation, the value of this condo in 2023 would be $638,000. Plus, I paid down some of the mortgage, $44,000 of that. So my gain on that condo is $282,000. So I kept one condo. I've made $282,000 over the next 5 years. But remember, I bought 2 more. I leveraged it. So my 2023 value on 75 the Esplanade, it's gone up another $133,000 on top of the initial gain that I made on the property. And the Canary Block condo goes up another $207,000. That's even above the initial gain on the property was. So that means by holding these properties for another 5 years, I get another $622,000 on these properties. So the results of maximizing my portfolio, I took $197,000 out of one condo. I invested in pre-construction, and that made me an initial return of $320,000. Then over the next 5 years at a 5% compounded annual growth rate, I expect those 3 condos to go up a combined $622,000 for a total gain of $943,000. It may sound crazy, but this is actually what happens. These are real life numbers on here. This has happened. This is in the past. So what happens if I didn't leverage my portfolio? Well, it does go up in value. At the end of my 5 years in 2023, 5% compounded annual growth wise, I make $622,000. The equity pay down at $22,033 before tax cash flow. Total gain without leverage $185,000. So if I compare the two, current gain of the leverage portfolio, I make $320,000. 5-year gain, the difference between the leverage portfolio, 5-year gain in the leverage portfolio wise, total gain of leverage portfolio, the difference 409%, and that's just the beauty of leverage wise, just going up in value over time. And this is my favorite slide in the whole presentation. This is my whole portfolio wise. And what I do is I look at what the value is going to be in 30 years. 30 years is very relevant because all my mortgages are going to have 30-year amortizations on them. So if I did nothing, absolutely nothing, and this is at a 3% annual growth rate. It's not even 3% annual growth rate, nice and conservative wise. I did nothing. We assume neutral cash flow. There will be positive cash flow on these. My value of my portfolio will be $33 million in 30 years. And what's that worth in today's dollars? Because there is inflation wise. So that's not real money. What's my purchasing power in today's dollars? So you can actually know what that tangible value is. $19 million. So by making all those investments, by leveraging the one property and using leverage as my friend, I've been able to build a portfolio that has a future value in 30 years worth in today's dollars, $19 million. I built my own pension fund. And Kyle, have you done this?
Yep, absolutely. Following the exact same steps.
So he doesn't have 16 total properties yet. It's baby steps, and I'm a little more aggressive. I'm not saying everyone should go and build that one as big. I was very aggressive wise, but that's just what you do, and you slowly build it up. Having one property is not going to build you financial freedom and generational wealth. It's using that leverage and time. Time is the true value of the currency. Time allows you to do this. Hey, Kyle, why don't you post a video of the, remember we did the weekly chat about was he Italian or Portuguese?
Portuguese, I believe.
Yeah.
Bus driver.
Kyle's going to post a great video wise. So yeah, I'm on here, Kyle's on here, Amit's on here, that kind of thing. But there was an article in the Toronto Star a few months ago about a Portuguese immigrant that came here with nothing, your typical story wise. And he worked for the TTC, right?
Yeah, he was a TTC bus driver.
TTC bus driver. What he did, he just bought real estate. Just bought real estate and he bought and hold. That's all he did. And he unfortunately recently passed away. And the value of his portfolio, I think, was $15 million value. So just simple. He just bought properties, rented them out, and they went up in value. And that's all he did. And had a $15 million portfolio when he passed away. So, that, and I actually see his properties for sale now on Shrub. Have you seen them?
Yeah, I've been watching them.
Yeah. So he has his properties on, because his estate has them on Shrub now, and you see them for sale now. So that's simply what we do, and we buy and we refinance and buy again. And Amit's done the same thing in his portfolio wise. So I'm gonna let Amit give a introduction. Let him tell you who he is.
Thank you, Alex. So I myself, I am a CA turned mortgage broker. I got my chartered accounting designation back in 2004. Got tired of counting everybody else's money, so I decided to get into real estate and onto the mortgage side. Been a mortgage broker for 12 years. Got a full team and staff that support me. And at the end of the day, the goal is to build a portfolio of properties for the exact same reasons Alex just mentioned. And something that I've learned is that for every $1,000 you want to spend a month, or every $2,000 you want to spend a month, have a property when you retire. So if you want to spend $10,000 a month when you retire, make sure you have 10 properties that are paid off and paying you rent in the future. So the goal at the end of the day is to build that portfolio.
Great example wise. And so that's phase 2 or phase 3 or whatever you want to call it. So we're using leverage now to grow our portfolio wise. So we're focused on an appreciation growth portfolio. When we get older, we will switch then to a cash flow portfolio. Cash flow does become important wise, but the key is if I'm 60, 70 years old, and as Emmett said, I want $10,000 a month to spend, your portfolio then will be paid off, and you'll be earning a cash flow on those properties wise. And then that's the income stream you will live on in the future. And all your properties are paid off as well. So you can even look at disposing of properties with them. So you want to use leverage to build your portfolio of 10 properties, let's say, so that later on in life you can live off of those properties. But if you only have the one and haven't used leverage wise, you're not going to have the 10 properties. So then when you retire wise, you can't live off one condo, but you can definitely live off 10 condos, and you use that first condo to get to the 10 condos. And it's just a slow and boring game, like I showed in the presentation wise. And what we like about condos, because I own multi-res, I have an apartment building in Hamilton, I own a multiplex in High Park, which I live in. Condos are concrete boxes in the sky. So really limited active items you have to deal with the property wise. With a multiplex or with a triplex or those kind of things, there are more items that you have to deal with having that freehold property wise. Kyle, since you've owned your property, how many times have your tenant reached out for issues in the property?
Just once, and it was a building related issue that property management had to resolve anyways.
So when you have a house or multiplex, you're getting those calls once a month or more. Condo, and the great thing is you're able to delegate that task out to the property manager because it wasn't an issue related to the unit. When it's a unit related issue, I can tell you what the issues are. The dishwasher, it's a dryer, it's a fridge, like washing machine. Those are the issues in the condo. There's nothing else that really goes wrong in the condo wise. So that's why we focus on the condo investments. They also tend to attract a higher caliber tenant as well. So you're not dealing with lots of turnover of tenants or anything like that, or vacancy issues wise or anything. So just getting into the different types of investment assets that we look at. So we'll just jump into the questions now. Love this first one. Oh, they all went away.
I answered them. They're in the answer tab.
Oh, they're in the answer tab. Okay. Okay.
Sorry, Alex. I'm always answering the questions while they're.
No
being
worries. I love
asked,
it. I
but
love
we
it.
can,
'Cause I
we
just
can
want to set
definitely
up.
look at it.
I just keep on
There have been
talking.
some good ones. I think it's worth covering them again.
Yeah. That's why I was excited about. Does this leverage and leverage strategy work when interest rates go back to 2008 levels? Love that question. Why I love that question is if you interest rates are going to be low for a very, very long time, and COVID is the reason why interest rates are going to be low for a very, very long time. The government has now taken on leverage wise to help get us through the current pandemic situation wise. Current deficit was $340 something billion.
323 billion.
Yeah, which I believe they said, and I don't remember what the year was, but it's actually last year. So the interest we're paying on that deficit is actually less than the interest we paid on our outstanding debt last year was. And that is purely a function of our current interest rate environment. We are not the only country that is in this situation. Every country in the world is in this situation wise. So we are not going to see interest rates going up anytime soon because we have governments that have taken on this new level of debt wise, and because we need to jumpstart the economy wise, and that we're in the treading water stage. The next stage is going to be the stimulus stage, and it's going to take a lot of time to repair the damage that's been done to the economy wise over this pandemic. So during that time, you're still going to see a low interest rate environment wise because the governments are trying to stimulate the economy. It's like if you're trying to get your engine started. So the economy is just like an engine. So they're going to have to continue to put oil in the engine to try to get it started wise, or gas in the engine to try to get it started wise, to ignite that fire and get it going. We aren't going to be in an increasing interest rate environment for a while. It could be 4 to 8 years until we're like that. And what were interest rates in 2008, Amit?
Yeah, if I could take a crack. So Alex, I loved your answer just now because it literally mimicked my answer that I wrote up like 3 minutes ago before you started.
Didn't even read it, guys.
I know you didn't. So if you actually open it up and see my answer, I think I literally said everything you said. So just to take a crack at it, yeah, interest rates were around 4% in 2008. What has changed? Regardless of what has happened due to COVID, my opinion prior to COVID was low rates are here to stay. And the reason for that is because we're turning into a global currency. We're turning into a global economy. You can't have any of the G7, G8, or G20 countries with an interest rate that's way outside of the scope of what Canada, US, Germany, England, Australia, all of them are. So what's been happening is rates have been on a steady decline since the late 80s, no matter how you look at the chart. And because of that, I don't want to predict this, but my guess is we may see negative interest rates in the next 5 years. We already see Japan and Denmark and Germany in the negative interest rate territory. I don't think it's a far stretch for Canada and US to go there, and I think COVID might be the tipping scale that takes us in that direction. But I agree with you. Rates, I think rates are going to be under 2% very soon, to be honest.
And everyone, what causes interest rates to go up? It's inflation. So you need to, so that's the interest rates and inflation. They balance each other out. So if you're getting high inflation, you increase interest to reduce consumption wise. And if inflation is low, then you can be in a lower interest rate environment wise. We're not in an inflationary pressure situation right now. And what causes inflation is if you have a runaway economy wise in regards to things, our growth is happening very, very quickly, and you want to tame that level of growth, so you increase interest rates. We're not in that situation. We're not going to be in that situation. So the counterbalance measure of increasing interest rates due to increasing inflation wise, it doesn't exist, and it's not going to exist. So that's why with confidence, and as Amit said before, like even going into COVID wise, we weren't looking at a huge jump of interest rates wise. And now definitely not. So really that's what we're looking at now. I think he's answering another question. There we go. Okay. 'Cause I'm like seeing the chair shake. I'm just looking at the questions now. So I don't even know, can other people on the other end see the questions? I don't.
Yeah, I'm responding so everyone can see. So under the answer section,
Okay.
I'm clicking on purpose, not private. I'm clicking so everyone can see my answers.
Perfect. Okay, good.
So it should say show all, I believe.
Okay, yeah. So Amit's writing the text version of the answers, and I'll talk as well. So what's it? If we assume that interest rates, worst case scenario, go back to 2008 levels, only 12 years ago, what will happen to a leverage investment on multiple properties? Won't they become significantly cash flow positive wise?
I think he meant cash negative.
Negative, yeah. But also as well, in a low interest rate environment wise, you're paying down equity on that property every year. So if you end up in, let's say, a low rate for 5 years, and then in the next period it's going up wise, you've already paid down a portion of that mortgage wise, big portion. As interest rates go down, every month you pay down more of your mortgage. As they go up, you pay down less of your mortgage on a ratio wise. So they also balance each other out in regards to at the end of 5 years. If your interest rates are higher wise, but you're going to have less debt at the end of 5 years. So there is a counterbalancing impact on that as well. Any other questions from anyone on here?
Yeah, there's 4 of them. If you scroll down, it's just been going into answered.
Okay. We talked about does that. I make the 70K. So anyone that's asking questions related, can I get approved for a mortgage wise? This is the beauty of working with a mortgage broker, and again, we like Amit because #1 in volume in 2018, 2019 in Ontario wise. He knows how to deal with investors. We're one of the top condo sales individuals teams in Toronto wise. For transactions. We were #1 in Ontario in 2019 for Remax wise. We know how to get deals done, and he knows how to get deals done as well. If you go into a local branch and you start talking about leverage and doing these different things, you are going so above the person's head that you're dealing with at the branch, the jack of all trades. They're not going to know what to do wise. And they're going to give you different answers than what Amit's going to give you. And it's not that they just lack the experience and knowledge wise how to get these deals done. Your mortgage broker, and again, why we align with someone that actually does this stuff, knows how to align your portfolio correctly to get you the mortgages. That's all about positioning the portfolio. So if you have questions about, oh, I make this income, I have these properties, how can I get a mortgage? I went to this person, they said no. Amit is the one that's going to be say, yes, we can get you a mortgage. Let's see who's going to provide that mortgage for you, depending on everyone's different lending criteria. So he works with so many different people, and it depends on how you structure your portfolio to allow it to grow wise. So
If I can add to that. So I started out at TD Bank, and what happens is that you only have the toolbox that TD has available to you. And so when you become a mortgage broker, I now deal with TD, Scotia, CIBC, Manulife, Desjardins, Tangerine, PC, and these are just to name a few. In Canada, there's 3 levels of banks. There's chartered A banks, which we all know, those are the branch guys. Then there's the banks that don't have offices, just to name a few: RFA, Radius, ICICI, IC Savings, Magenta. These are all companies people haven't heard of. The reason I'm mentioning it is because every bank has small nuances that are different, and it's those differences that allow you to get a mortgage. So what I always tell my clients, it's not about if you can get a mortgage, it's about at what rate and at what bank I'm going to get it for you at. So everybody can get a mortgage. It just depends what interest rate and what bank we're going to get it at. The problem is when you if you had walked into TD on me 10 years ago, I would only be able to answer you the ability of TD to give a mortgage, not Scotia, not BMO, not Royal, not a credit union, not a B lender. Now I'm able to do all that. So, and again, attesting to what Alex said, given that I deal mostly with investors, I know exactly where files need to go. Whether you own 1 property or 25, it's not a problem.
And yeah, I actually lost my train of thought earlier. Was Amit just doesn't work with us. He works with the top condo agents across Toronto. He works with the top people bigger than me. He works with out there wise, and people that own double-digit condos out there. So he knows how to deal with all these more complex files wise. That's what you're getting with that expertise wise. He's done the deals. He's been through them. He knows how to get these deals done and how to structure them in different ways. And I've personally used him as well and referred him to our clients wise.
Thank you, Alex. Appreciate that.
No problem. And I can say, like, recently that question that Keith asked, I had a very similar question to that from someone. Similar income bracket that had a couple of. He didn't have as many as you, Keith, but he had a couple investment properties. And he's like, I went to the bank, and they said no. They said talk to Amit, and Amit unlocked on the first property right off the bat $220,000 worth of equity.
Yeah, we just did that.
Yeah, just did that. And the guy went somewhere and he said I couldn't get it done. And all of a sudden $220,000 of investable income came available wise. So it's always best to talk to the experts that actually do what they do. I'm not going to sell a commercial building. I'm not going to do a commercial lease. I know nothing about that. I focus in on making people money through investment real estate wise. Kyle, you got anything you want to add? I'm just throwing him like he hates it when I throw him on the spot wise.
No, I think you've nailed it, From my experiences, Alex and I started investing together. We bought that one first condo. I have refinanced that, which has allowed me to purchase additional units. And now I'm just waiting for some of those to be completed so that I can take equity out of them. So it does take time. You need to start investing. And then that's how you do grow your portfolio, using that leverage and exponentially starting to get more and more properties, and using the right partners like ourselves to purchase real estate, or Amit to finance the mortgages and refinance your properties. That's how you grow and be successful in real estate over the long term.
And just long and boring. Great questions.
Alex, I like this question. I don't know if you got to it, the one from Harnek Sidhu.
Yeah, go ahead.
It says, my personal income is 220 to 300K. I'm in the high tax bracket. I've tried to lower my taxes by investing in dividends, government, huge tax credits, etc. I've avoided investing in real estate because rental income would be taxed at the marginal rate. how does leverage help make rental properties enticing to high income earners?
Jump on it. All yours.
So what my opinion of the matter on this is that, yes, you may be in a high tax bracket. Let's call it the 45% or 46% tax bracket. Now, if the average condo in Toronto has a $2,000 rent, the annual rent is going to be 24 grand. But the part that people forget is you can deduct mortgage interest, maintenance, property taxes, closing costs, renovations, advertising, cutting keys, your accounting charges, everything. So from my experience from my accounting business is that you can probably bring that 24,000 down to about 1,500 bucks on an average basis, or maybe a little bit more, maybe a little bit less. So the marginal tax impact is negligible. So to avoid investing in properties because of the tax consequences, I think that's a short-term issue, because the bigger advantage, and this, Alex, you can jump in on this, is it's the upside potential that's so much more important.
Exactly. Okay. So, also noticing here in regards to the basement rental wise, they're just adding in another question here. I do like this question. So some people include basement rental income, some people don't, correct? Banks wise?
Sorry, I missed that. You said some people.
Oh, they're in the open questions now. The
I
top
see.
basement rental income.
So my income is approximately 115K. I rent my basement for 1K, so perhaps 500K could be more realistic. So I'm imagining they're asking what their limit would be. So again, mortgage limits these days, they're about 5 to 6 times people's income. So 115 times 5 is 580, 575. That would be the mortgage limit. Whether you buy a $1 million house or a $10 million house, the mortgage is limited by your income. And then obviously the rent in the basement would be offset, but I'm assuming that's the question that's being answered here.
Yeah. So does anyone else have any more questions or anything we'd like to add? Again, it's a shorter one today because we had a smaller group. So you have our undivided attention wise. But next week it's going to be much larger wise, so we won't be able to answer probably most likely as many questions.
I think maybe the other thing, if you wanted to discuss, just sometimes people wonder about corporate holding and not. That's always something that investors need to know, and we've always provided guidance on. If you want.
Yeah, so that's a great question, Wise. There's a misconception out there if you're holding a property in a holding company, Wise, that you can't get a mortgage or it's more expensive. Not the case at all. Very easy to own properties in holding companies, Wise. You don't want to own them in your operating company wise. It's your holding company you want to own these assets in. So the misconception out there that if you own a holding company wise, and especially if you're self-employed, you want to have your properties in holding company wise. Self-employed, incorporated, self-employed. You want to have them in a holding company wise, but it's not difficult to get mortgages on those properties. So I'm not seeing any more questions coming up. So this is going to be, there'll be a recording of this. This will be forwarded to everyone that signed up and attended wise. Thank you so much for coming on. We'll be doing this again next Thursday again at 11 a.m. And thanks for coming on.
I think we'll just put our contact details.
Yeah. Share your contact details in the chat. Amit's details are going to be there coming up any second. Did you post them in there?
I did, yeah.
I haven't seen them come up yet.
Just in the chat.
Is it in the chat? I'm in the chat.
Distributed with a copy of the webinar today, anyways. In the email.
Everyone that signed up for the webinar is going to get a copy. So,
and I think if anyone had any questions that they didn't ask, just for privacy reasons, Alex, Kyle, myself are available anytime. So if there's anything that comes up and you want to give us a call or an email, we're always here. So, I mean, that's the whole point of this team.
Yep. Perfect. Okay, guys.
Thank you.
Okay, talk to everyone later. Okay.
Bye.
Yes.
Bye-bye.
Bye.